The stock market is in big trouble. Both insiders and super investors are now dumping their stock, taking advantage of the market surging to new all-time highs, with the S&P 500 just closing above 5,800. A number of leading economic indicators are now pointing towards imminent turmoil across the economy, which means we could be heading for a major correction in the stock market to bring these valuations back in line. The economic situation is now so precarious that a number of major banks and super investors are now starting to raise the alarm on what could not only be a catastrophic drop in the stock market, but something potentially even worse across the wider economy. Some people will argue that the stock market will just keep surging to break new all-time highs, and others will argue that we will soon see a major market crash. However, stock market indicators don't lie, and right now many tried and tested indicators are pointing towards stocks having historically high valuations. The S&P 500 forward PE ratio just increased to 21.8, highs that have not been seen since the 2021 stock market bubble and also the dot-com bubble in the early 2000s. And the Wilshire 5000 to GDP ratio, now often dubbed the Buffett indicator, just reached a whopping 200%, which is the highest it has ever been throughout history. The indicator measures the total market value of US publicly traded stocks divided by the US GDP to get a ratio of stock market size relative to overall economic output. So as the ratio gets higher, it means that the stock market valuation is higher relative to the actual output in the economy. This new peak of 200% means that the total value of the US stock market is double that of the US GDP, and is a ratio that eclipses the previous highs seen during the dot-com bubble, as well as during the 2021 bubble that came during the early stages of the pandemic, with all of the stimulus check money being pumped into the financial system. Warren Buffett famously said in 2001 that the indicator is probably the best single measure of where valuations stand at any given moment, and that if the ratio approaches 200%, then you are playing with fire. If this statement from 20 odd years ago still holds true, we can assume that Warren Buffett must believe that the stock market is overvalued today. And in fact, we can see patterns of market behaviour from Buffett in recent months that do suggest that he does indeed believe that valuations for many stocks are simply too steep to justify holding right now. Warren Buffett's Berkshire Hathaway has been a net seller of stocks in 2024, with net sales totaling a whopping $93 billion, and this includes large sales in big names like Apple and Bank of America, amongst others. Now, to put into context just how big of a deal this is, this table here shows previous years in recent history where Berkshire Hathaway have been net sellers of stocks. 2023 was the year with the largest net sales at $24.2 billion. So these sales that Buffett has made so far this year in 2024 are dwarfing any previous selling spree in the past. And Buffett now has a staggering $277 billion in cash and short-term cash equivalents, which is sitting on the sideline waiting for valuations to become more attractive, and it's clear that Buffett doesn't see much value in the market at this current moment in time, judging by how big this cash position is relative to his stock positions. A big new stock market warning is also coming out from Goldman Sachs, who believe that the S&P 500's decades of big gains is over. Strategists at Goldman Sachs believe that US stocks are unlikely to sustain their above-average performance of the past decade as investors turn to other assets, including bonds, for better returns. And in this report, the analysis by Goldman Sachs does say the S&P 500 is expected to post on an annual level nominal total returns of just 3% over the next 10 years, compared to 13% in the last decade and a long-term average of 11%. They also see a roughly 72% chance that the benchmark index will trail Treasury bonds, and a 33% likelihood that they will lag inflation through to 2034. Goldman Sachs also highlighted that the most important variable for their stock market forecast is the starting valuation, which they prefer to use the cyclically adjusted PE ratio for the S&P 500, which right now is sitting at 38, which is a historically high level. The report does say that a high starting price, with all else being equal, implies a lower forward return, which holds true looking at this recent chart published by Apollo Research showing the relationship between the forward PE ratio and the subsequent annualized return of the S&P 500. And as you can see, there is a negative correlation between the two variables, and as forward PE ratios rise, the subsequent annualized returns have declined historically. Goldman Sachs are also concerned about the surging market concentration amongst the largest 10 companies, which is at a multi-decade high, and is also following a trend that also occurred in 2000 and in 2009. Now, another red flag emerging within the stock market is the recent surge that we have seen in the number of corporate insiders who are selling shares of their own stock. This chart shows that the ratio of sells to buys has been steadily trending upwards since midway through 2022 and recently spiked up to reach highs not seen since 2021. Now, this is a key gauge of insider sentiment, as it does show how confident those within a company are on future stock performance. So seeing that insiders are dumping their stock is not a very positive sign on where things could be heading in the future while stocks are at current prices. Insiders include high-level executives and CEOs from some of the largest companies in the world, including Mark Zuckerberg at Meta, Jensen Huang at Nvidia, and Sundar Pichai as well at Google, who are all dumping shares in their respective companies at noticeable sizes. Now, of course, some of these sales may not have anything to do with future business and stock outlook. However, there is certainly a general trend that has been emerging. The big problem with stocks being at historically expensive valuations right now is that a strong economy is pretty much needed for companies to sustain performance and experience growth in revenues and profit, and therefore to sustain stock prices. There are many economic indicators that suggest that this is absolutely not the case right now, including the Conference Board's Leading Economic Indicators Index, which just declined by a further 0.5% month over month. This index is now the lowest it has been since 2016 and has now declined for 30 out of the last 31 months, which is the most severe downturn we have seen since the global financial crisis in 2008. The index does take into account a number of leading indicators on the health of the economy and if things are generally improving or getting worse, and a drawdown of this extent of the index has never occurred outside of a recessionary period before. Deteriorating economic conditions are therefore not a positive sign for corporate performance and will make it much harder for companies to sustain and grow their earnings. The CEO of banking giant JP Morgan, Jamie Dimon, has also issued warnings about the current global economic situation, particularly around continuous geopolitical tensions in the Middle East. In their latest earnings call, he did say that the situation in the Middle East is treacherous and getting worse, and that the outcomes of these situations could have far-reaching effects on both short-term economic outcomes and, more importantly, on the course of history. The recent retaliation that we have just seen from Israel on Iran has only escalated these tensions even further, which could have a big impact on the energy markets, such as the oil market. And Dimon also did warn that the US specifically could face consequences including inflation, fiscal deficits, and also infrastructure issues. Now, JP Morgan has long been warning of an upcoming recession in the US, and the bank has given only a 35 to 40% chance that the economy does avoid a recession, and it also gave a 35% chance that a recession will happen by the end of 2025. So with stock market valuations being at historically high levels and the economic outlook getting worse and worse, it is hard to be bullish on the stock market right now. However, with that being said, nobody does know what is going to happen, and we could see the bull market continue to rage on into the next presidential election and beyond. Especially as we know that the US government is willing to take on new debt at a record-breaking pace in order to prop up and stimulate the economy, and there are no signs of this stopping anytime soon. There are a whole load of other signs of weakness across the US economy as well, including concerning signals in the labour market and also in consumer strength, which appears to be declining at a rapid pace. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.